Most traders are taught one rule very early in their journey: cut your losses quickly. It is repeated everywhere, in books, in trading communities, in mentorship groups. But there is another habit that quietly destroys traders, and almost nobody talks about it: cutting your winners too early. You finally enter a trade after waiting for your setup. Price begins to move in your direction. You see green on the screen. Your account is finally in profit, and something immediately changes inside you. Your heart rate increases. Your attention locks on the profit number. Suddenly, your mind whispers one simple sentence: close it now, before the market takes it back. So you close the trade. You feel relieved for a moment, because at least you secured something. Then a few minutes later, you look back at the chart. The market keeps moving. The same trade you closed continues running. Another 100 points, another 200 points. And you sit there watching it move without you. Not because your analysis was wrong, not because your setup failed, but because fear made the decision. This is where many traders misunderstand their real problem. They think they need a better strategy. They think they need more indicators. They think they need a different system. But the real issue is often psychological. It is the fear of seeing profit disappear. Today, we are going to talk about why traders cut their winners early, and the hidden fear that quietly drives this behavior. Many traders spend a lot of time talking about their losing trades. They complain about stop losses. They talk about the market taking their money. They say the market hunted their entries. But when you look deeper into most trading histories, you begin to notice something very interesting. The real problem is not losing trades. The real problem is something quieter. It is the inability to let winning trades grow. Many traders exit the moment they see profit. The trade moves slightly in their favor. Their account turns green, and almost immediately, they close the position. Not because the setup is finished, not because their target was reached, but simply because profit appeared. At first, it feels responsible. It feels like discipline. You tell yourself, at least I secured something. But what is actually happening is a psychological reaction. Profit feels fragile. It feels temporary. Your mind starts telling you a story. If I do not take this profit now, the market might take it back. So, the decision is made quickly. You close the trade, not because your analysis said to exit, but because fear appeared. Fear that the profit you see might disappear. And that fear quietly trains traders to accept smaller and smaller wins. Now, here is where the psychology becomes even more interesting. When a trade first opens, the profit is just a number. It feels like potential money, something that might happen if the trade continues. But the moment the trade moves into profit, something changes inside the mind. That number stops feeling like potential. It starts feeling like something you already own. And once your brain believes you own something, losing it becomes painful. This is a well-studied psychological principle called loss aversion. Humans feel the pain of losing much more strongly than the pleasure of gaining. Losing $100 feels worse than the satisfaction of gaining $100. So when your trade is in profit, your brain begins trying to protect it. Not because it understands trading, but because it wants to avoid the emotional pain of seeing that profit disappear. Your mind is no longer thinking like a trader managing probabilities. Your mind is thinking like someone protecting a possession. And the fastest way to protect profit is very simple. Close the trade. Closing a trade early often feels like the responsible thing to do. You secure profit. You avoid risk. You protect what the market has already given you. In that moment, it feels safe. You look at the profit and think, at least I did not let the market take it back. You feel disciplined. You feel careful. But there is a hidden illusion inside that decision. Because every time you close a winning trade too early, you are quietly training your brain to accept a dangerous pattern: small wins and large losses. Think about what usually happens when a trade moves against you. Fear tells you to wait. Maybe the market will come back. Maybe it is just a temporary pullback. Maybe it will reverse. So you hold the losing trade longer than you should. But when the trade moves in your favor, fear appears again. Only this time, it tells you the opposite. Take it now, before it disappears. So you close the trade quickly. Not because the analysis changed, not because the setup failed, but because fear appeared in a different form. One fear tells you to hold losers. The other fear tells you to close winners. When both behaviors exist at the same time, they create the worst possible trading equation. Small winners, large losers. And slowly, your account begins to bleed. Not because you cannot read the market, not because your entries are terrible, but because your mind cannot tolerate uncertainty while the trade is in profit. Now, there is another psychological pressure that makes this even harder: watching profit fluctuate. Very few traders talk about how uncomfortable this feels. Your trade moves into profit. You see $200. A few seconds later, it drops to $150. Then it moves up again, then down again. Your screen might show something like this: plus 200, plus 150, plus 180, plus 130. Even though the trade is still profitable, your mind begins to panic because it feels like you are losing money. Your brain starts comparing the current profit with the highest profit it already saw, and every drop from that number feels like something is being taken away from you, even though the trade is still winning. This is the emotional trap. Profit movement begins to feel like loss. So the easiest way to remove that uncomfortable feeling is simple. Close the trade. The moment you close it, the emotional pressure disappears. But the real reason the trade was closed had nothing to do with the setup. It had everything to do with the mind trying to escape the discomfort of watching profit fluctuate. Professional traders approach this situation very differently. They do not manage trades based on how they feel in the moment. They manage trades based on structure and probability. Before they even enter a position, many of their decisions are already made. They already know where the trade becomes invalid. They know the exact level that proves their idea is wrong. They already know where partial profits may be taken if the market reaches certain areas. They also know where the full target of the trade is located. All of these decisions are made before the trade begins. So when the market starts moving, something very important happens. They are not making emotional decisions while watching the chart. They are simply executing the plan they already created. If the trade fluctuates, nothing inside them changes, because fluctuation was already expected. If profit pulls back slightly, they do not panic because they are not reacting to every small movement on the screen. They are following a predefined structure. This is the difference between emotional trading and professional execution. Amateurs react to what they see. Professionals execute what they planned. And that difference alone can completely change a trader's results. Now there is one simple discipline that can transform the way a trader handles winning trades. It sounds simple, but very few traders truly practice it. Decide the exit before you enter the trade, not while you are watching profit appear on the screen, not when the trade is already moving and emotions are involved, before the trade begins. When you are calm, when you are thinking clearly, when there is no pressure. Because once a trade is open and profit appears, your emotions become part of the decision-making process. Fear begins to whisper. Greed begins to appear. Doubt begins to grow. And in that moment, logic becomes weaker. But if the exit was already decided earlier, the decision becomes easier. You are not negotiating with your emotions. You are simply following the plan you created when your mind was calm and clear. When the market moves in your favor, your responsibility is not to protect your feelings. Your responsibility is to follow the structure you already committed to. Take a moment and think about your own trading experience. How many trades have you closed early, only to watch the market continue moving in the same direction without you? You close the trade feeling safe. Then, a few minutes later, you look back at the chart and the market keeps running. The move becomes bigger, stronger, exactly the direction you predicted. But you are no longer part of it. Think about how many times that has happened. How many times did that small voice in your mind whisper something very familiar? Take it now, before the market takes it back. And in that moment, it felt logical. It felt responsible. But later you realized that the decision was not based on structure. It was based on fear. Now ask yourself another question. How many times has that fear cost you the biggest move of the day? The trade that could have changed your entire session. The trade that could have paid for multiple small losses. But it was closed too early. Not because the market invalidated the idea, but because the mind could not tolerate uncertainty while in profit. This is one of the quiet battles every trader must learn to face. The market does not reward fear. It rewards patience. It rewards discipline. It rewards the ability to follow a plan, even when emotions try to interfere. If you have ever closed a winning trade too early, comment one word. Patience. Not for me. For you. And if you want to understand the psychological patterns that quietly destroy traders and how to fix them, subscribe to the Daily Trader Mindset.